When most people see stocks falling, bonds falling, gold falling, and crypto falling, all at the same time they assume the world has changed in some mysterious way. They assume the market has become irrational. They assume the old rules broke. I do not see it that way. I see a machine. And if you do not understand that machine, you will keep making the same mistake every time fear arrives wearing a different costume. A great many people were taught a childish version of investing. They were told that stocks are risky, bonds are safe, gold is protection, cash is boring, and diversification means one thing will rise when another thing falls. That story is neat. It is easy to remember. It also breaks down the moment the system gets starved of liquidity. That is the moment when men stop selling what they dislike and start selling what they can. That is the moment when the market shows you its real hierarchy. Cash first, everything else second. And once you understand that, you begin to see why so many people get crushed in a panic without ever understanding what actually hit them. The document you gave me circles around a truth that I believe far more investors need to stare straight in the face. We do not live inside a calm savings-based system. We live inside a debt-fed system. The whole structure sits on top of ever larger promises, ever larger balance sheets, and ever larger assumptions about tomorrow. Governments owe more, households owe more, companies owe more, investors borrow against assets they do not fully own. Funds borrow against positions they assume they will have time to exit. The system expands because prices rise, incomes rise, tax receipts rise, and old debts become easier to carry in a world where nominal numbers keep getting bigger. That is the real operating principle. Not stability, expansion, not restraint, rollover, not cash discipline, asset inflation. If you miss that, you will look at the modern financial world and imagine it is built on prudence. It is not. It is built on serviceability. That is a different word. It is a harsher word. It means the machine does not ask whether the debt is beautiful. It asks whether the payments can still be made. That difference matters. Imagine a family with a large mortgage and a decent salary. As long as income rises, the house payment becomes easier to carry. The debt has not changed, but the burden feels lighter because the wage base beneath it has expanded. Now imagine that same family gets a pay cut, loses overtime, faces higher food prices, and watches insurance costs creep up. Suddenly the same mortgage feels like a trap. The house did not change. The debt contract did not change. The pressure changed. The cushion changed. The margin disappeared. Scale that logic from one family to an entire civilization, and you begin to understand the present age. Governments need nominal growth. Companies need nominal growth. Consumers need nominal growth. Investors using borrowed money need nominal growth. The debt machine breathes easier when prices, incomes, and asset values trend upward. It starts choking when growth stalls, when cash flow tightens, and when collateral falls at the same time leverage remains in place. That is why I want you to stop thinking like a tourist and start thinking like an owner of a system. The market is not a popularity contest between sectors. It is a continuous test of who can still meet their obligations under changing conditions. The first mechanism inside that machine is what I call the inflation ladder, a debt. Heavy world quietly depends on tomorrow. S dollars being easier to produce than today. S obligations were to sign. People call that many things. I call it the ladder. Wages rise, prices rise, tax collections rise, asset values rise. Debt that once looked intimidating becomes more manageable because the denominator changed. If a country, a company, or a household owes a fixed amount while its income base grows, the debt burden becomes more serviceable. That is why truly persistent deflation is poison in a leveraged system. A falling price level sounds wonderful to people who have not thought past the first sentence. They imagine cheaper goods and better living. What they forget is that debt does not politely shrink because your income opportunity shrank. A falling nominal world with a giant debt stack is like trying to climb upward on a ladder while somebody is sawing off the bottom rungs. That is why authorities always develop a deep hatred of deflation the moment it becomes real. The second mechanism is what I call collateral gravity. Borrowed money behaves well on the way up and brutally on the way down. When investors borrow against rising assets, the arrangement looks intelligent. Gains feel amplified. Confidence rises. More borrowing appears justified. The collateral looks strong precisely because price strength flatters the structure. But gravity in markets is never measured on the way up. It is measured when the collateral starts slipping. The moment collateral falls, the lender stops admiring your story and starts checking your margin. That is when the cheerful language of upside disappears and the cold language of maintenance arrives. You must post cash. You must reduce exposure. You must sell something not next quarter. Now this is where amateurs get trapped because they think a margin call is a technical inconvenience. It is not. It is a forced liquidation schedule. It is a countdown clock. It is the point where your opinion about long-term value becomes irrelevant because the system is demanding cash within a window that your illiquid convictions cannot satisfy. A man with rental property, private deals, and physical metal may still get cornered if the thing demanding payment is his brokerage account and the thing he can actually convert into cash in 48 hours is not the property he loves, but the liquid asset he can click and sell. That is the third mechanism, and it is the one that confuses people most. I call it the liquidity pecking order. In a real liquidity crunch, investors do not dump whatever they think is worthless. They dump whatever settles fastest. Read that again. They do not sell what they want to sell. They sell what can save them in time. That is why during true stress you may see stocks fall, treasury bonds fall, gold fall, silver fall, and crypto fall together. The headline reader gets dizzy. He says nothing makes sense anymore. The system reader does not get dizzy. He recognizes the pattern instantly. A machine short on cash is stripping itself for parts. It is not making a philosophical statement about the future of civilization. It is raising liquidity. I have watched investors make this mistake for decades. They assume that if gold is sound, it must rise every day that fear rises. But if a leveraged holder of gold has a margin call in another part of his book, he may sell the gold anyway. Not because gold failed him, because gold was liquid. The same is true for treasury exposure, broad equity funds, and anything else that can be turned into cash faster than private real estate venture positions, or some wonderfully illiquid side bet that looks sophisticated in good weather. That is why a sell everything period is so revealing. It tells you what is liquid. It tells you who was overextended. It tells you who had no spare cash. It tells you who was pretending to own assets when in truth the liabilities owned them. Now let us carry this one level deeper, because the mother draft you gave me does not merely argue that everything fell. It argues why that fall can reverse after the immediate scramble eases. That part matters because too many people confuse a liquidity event with a permanent regime change. These are not the same thing. A liquidity event is a fire in the hallway. A regime change is when the house itself has been structurally condemned. The market punishes both, but the response afterward is entirely different. If the panic is driven by a temporary dash for cash, by margin compression, by forced selling, by cross-asset liquidation, then once pressure eases, the system often tries to return to its preferred path, and in a debt-driven world, the preferred path is not austerity. It is reflation. It is renewed expansion. It is more breathing room for debt. It is the return of the inflation ladder. It is the return of the idea that nominal prices must keep rising because too much of the world's balance sheet assumes they will. That is why I have always told people not to confuse volatility with invalidation. A dip is not automatically a bargain, but a forced dip inside a system still designed to reflate can become a bargain if you know what you own, if you are not over-leveraged, and if you still have buying power when other people do not. That is the identity flip most investors never make. They move through life as price observers. They need to become liquidity owners. A price observer panics when prices fall. A liquidity owner asks a better question: Who is being forced to sell this to me and why? That one question will make you richer than most financial entertainment ever will. The fourth mechanism in this machine is what I call the policy backstop illusion. People talk as if authorities are all powerful. They are not. But in a debt-heavy system, they are rarely neutral. They may not prevent every downturn, and they may not stop every air pocket. But they do possess one enduring instinct. They will choose future currency weakness over present debt collapse. If cornered hard enough, they may disguise it, they may delay it, they may call it relief support, stabilization, flexibility, or emergency measures. But the mathematics underneath remains the same. A heavily indebted system can tolerate inflation longer than it can tolerate widespread debt deflation. That is why prolonged recessions and true deflation scares tend to produce a familiar answer eventually: more liquidity, more accommodation, more money. Maybe not immediately, maybe not elegantly, but eventually you do not have to admire that answer. You merely have to recognize the odds of it. An investor who refuses to understand the incentives of the system because he dislikes the morality of the system is still an uninformed investor. I prefer clear eyes over moral theatrics. Now let me turn from the machine to your portfolio, because theory without action is a hobby. If I were speaking to a family, a small business owner, or a young investor after a sudden market drop in 2026, I would not begin with stock tips. I would begin with architecture. The first rule is that you must not place yourself in a position where volatility can force you into stupidity. That means no excessive margin. I have seen brilliant people ruined, not by being wrong about value, but by being right on a schedule they were too indebted to survive. There is a world of difference between being temporarily underwater and being carried out because the lender demanded oxygen before the tide turned. Debt eliminates patience. Margin destroys optionality. It converts a drawdown into a deadline that is a terrible trade for most human beings. The second rule is that you stay invested, but you stop worshiping a single asset class. The mother draft argues for broad equity exposure, international diversification, and meaningful exposure to precious metals. Underneath the rough presentation, that logic is not foolish. I would phrase it differently. But the backbone is sound. In a world designed toward nominal expansion, productive businesses remain essential long-term holdings. I want ownership in enterprises that adapt, earn, reinvest, and survive. A broad American equity fund can serve that role for many families. Some exposure to the wider world is sensible because no empire rings a bell before it ages, and a sensible allocation to gold and perhaps silver is not paranoia in a debt era. It is recognition that governments can dilute currency more easily than they can print trust. But here is where adults separate from slogan repeaters. Diversification is not a religion. It is a job description. Every holding must know why it is in the room. Businesses are there for productive compounding. International assets are there because concentration risk is real. Precious metals are there because monetary discipline is rare. Cash is there because opportunities belong to the patient. If you do not know why you own something, you do not own it. It owns your mood. The third rule is simple and unpopular. Buy the dips, but buy them like an engineer, not like a gambler. People love the phrase buy the dip because it sounds bold. What they usually mean is guess the bottom and pray. That is not investing. That is performance anxiety and financial costume. What I prefer is deliberate accumulation. If markets fall and your long-term thesis about productive assets is not broken, buy in stages, buy with a schedule, buy with enough humility to admit you do not know the exact low, buy with enough discipline to keep cash reserves for further weakness. The point is not to impress anyone with a heroic entry. The point is to build ownership at better valuations while keeping your emotional circuitry intact. Dollar cost averaging is not exciting, but it does something very few investors manage on their own. It keeps ego from driving the car. The fourth rule is that liquidity is not dead money. It is stored courage. This is especially hard for people in inflationary periods. They feel cash is lazy. They feel uninvested. Cash is a confession of fear. Sometimes it is, but sometimes it is the reserve tank that keeps you from selling quality assets at the wrong time. Sometimes it is the difference between watching a crisis and using a crisis. I do not want all my capital idle, but I want enough ready capital that sudden disorder feels like a shopping season instead of a personal emergency. The fifth rule is that your portfolio should acknowledge the difference between nominal survival and real wealth. This is where gold becomes emotionally misunderstood. Gold is not a business. It does not innovate, hire, advertise, build factories, or compound through retained earnings. That is why I do not treat it the way I treat a great company. But in a system where the cure for stress is frequently more currency, it serves a role. Not because it produces cash flow, because it limits your dependence on the moral restraint of policymakers I do not fully trust. A small metals allocation can be intellectually honest in a world like this. Too much becomes fear worship. Too little becomes monetary naivete. Balance matters. The sixth rule is that international diversification should be deliberate, not fashionable. Many investors hold only domestic assets because that is all they know. I understand that instinct. But home bias becomes dangerous when it turns into imperial certainty. If all roads of your financial life point to one currency, one market, one tax regime, one government debt structure, and one political machine, then you are more exposed than you think. I still want a meaningful stake in American productive strength. I always will. But I do not confuse admiration with exclusivity. Now let me address the most seductive mistake of all. It is the belief that because the debt machine prefers inflation, every price decline must be temporary, and every asset must inevitably recover. That is not true. The system can want reflation and still crush bad businesses. It can want nominal growth and still punish excessive leverage. It can want higher markets generally and still leave foolish investors behind. The debt machine does not rescue stupidity evenly. That is why asset selection still matters, quality still matters, balance sheet strength still matters. Free cash flow still matters, management still matters, moats still matter. If you buy everything simply because the currency may weaken, you will still discover that some boats float while others sink. That is where character enters the equation. I have spent my life trying to buy productive assets when the gap between price and value is generous. That discipline matters even more in a system where panic can briefly dislocate both. The opportunity is not in fear itself. The opportunity is in fear mispricing durable earning power. When a liquidity crunch smashes everything, it creates camouflage. Good businesses and weak businesses can both be marked down in the same ugly week. That is where the prepared investor gets paid for prior thinking. He has already studied what he wants. He already knows which businesses have real earnings, real cash flow, low leverage, and enduring demand. So when the forced sellers appear, he does not begin his homework. He executes it. That is what I want for you. Not hot takes, preparedness. Not cleverness position, not heroic systems. The system I would build for 2026 is not complicated, but it requires emotional maturity. I would hold a core in broad productive equities. I would add to that core during fear rather than during euphoria. I would maintain some international exposure because concentration risk has a way of hiding in patriotic language. I would hold a measured allocation to precious metals as a hedge against the policy reflexes of indebted governments. I would avoid reckless leverage entirely. I would keep liquid reserves, and I would remember that asset sell-offs often say more about funding pressure than about permanent value destruction. That brings me to the hardest truth of all. Most people do not lose because they lacked information. They lose because they built a financial life that could not survive the emotional pressure of volatility. They borrowed too much, they concentrated too much. They assumed liquidity would always be there. They treated rising prices as evidence of personal genius. They entered storms with no dry powder. They mistook diversification for random clutter. And when the machine finally demanded cash, they discovered that what they thought was a portfolio was really a collection of future obligations tied to past optimism. I do not want that life for you. I want you to stop admiring markets and start understanding balance sheets, incentives, and liquidity chains. I want you to build the sort of financial structure that does not depend on being right every month. I want you to hold enough quality, enough patience, and enough cash that other people's forced selling can become your opportunity rather than your funeral. In every panic, there is a transfer, not just of money, of temperament. Assets move from the impatient to the patient, from the leveraged to the liquid, from the headline addict to the quiet accumulator, from the man who needed tomorrow to happen on schedule to the one who prepared for the fact that it never does. That is the real game. And once you see it, all the surface noise begins to look smaller. Stocks fall, fine. Gold falls, fine. Bonds wobble, fine. Those are symptoms. The real question is always the same: who needs cash tonight? And the second question matters even more: will you be the one who needs it or the one who has it? That is the dividing line between fear and power. That is the dividing line between reacting to the machine and using it. That is the dividing line between a person who chases reassurance and a person who compounds wealth. Most people spend their investing life trying to predict what the market will do next week. I think that is a low-return use of a human mind. I would rather ask what kind of system we are living inside, what incentives hold it together, what breaks first when stress arrives, and what assets I would be proud to own if someone handed me a sale tag created by panic. The answers are not glamorous. Own productive assets, keep reserves, avoid leverage you cannot survive, respect liquidity, diversify with purpose. Treat metal as insurance, not a religion. Buy weakness with discipline. Never confuse cash pressure with permanent truth. If you can do that, then a market drop stops being an identity crisis. It becomes an exam you expected. And if this debt-driven world does what debt-driven worlds usually do, it will continue reaching for inflation, nominal growth, and larger balances to postpone discipline. That will create more bubbles, more corrections, more panics, more sell everything episodes, and more chances for sane people to acquire good assets from desperate hands. So do not waste this lesson. The next time you hear somebody say that nothing makes sense because everything is falling together, do not join the confusion. Look for the machine, look for the leverage, look for the cash shortage, look for the forced seller, look for the policy reflex waiting in the background. And most of all, look in the mirror. Ask yourself whether your own financial life is built like a fragile speculation or like an operating system meant to survive disorder. Because wealth is not built by avoiding every storm. It is built by refusing to enter storms with a balance sheet that can betray you. That is the contract. That is the test. And that is the choice in front of you now. You can keep drifting through markets believing that price is truth. Leverage is sophistication, and diversification is a pile of things you do not understand. Or you can step onto the other side of the table. You can become the person who understands why everything fell, why some of it will recover, why some of it never should have been owned, and why liquidity, patience, and disciplined accumulation are worth more than prediction theater. One path turns every shock into panic, the other turns panic into inventory. One path leaves you begging for the machine to be kind, the other lets you profit from the fact that the machine is not kind at all. Choose carefully in a debt bubble. The world does not reward the most emotional investor. It rewards the one who can still think when everybody else is selling what they can, not what they want. That is when fortunes change hands. That is when financial adulthood begins. And that is when I want you to be buying, not begging.